Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And it is my great pleasure today to welcome a new guest to the channel, Mr. Don Durrett from Goldstock Data. Guys, we're going to be talking all things precious metals today, from the bullion itself all the way through to the famous Junior Explore codes. We're going to get Don's take on various aspects of the market. Disclaimer, nothing we say here today is advice, but if you're interested in learning more, Goldstock Data and all of Don's links will be in the description, and you can get in touch and learn more. Don, it is a great pleasure to have you on the channel. How are you, sir?
Great, Ben. Thanks for having me on. One thing about the title, return on investment, gold has really only had two cycles, 1970s and the 2000s, where ROI really paid off. And we've been in 10 years of a bear market, but now that we're getting ready to flip, we're getting ready to go into a bull market. We can talk about that. And
Certainly.
it's going to make sense finally for people to think about gold and silver as an ROI.
Yeah, I think you touched on an important point. A lot of people see gold, particularly as like your currency hedge, your store of value over time, perhaps not necessarily a return on investment in and of itself. I've been in gold since late 2018, since I first started to learn a little bit more about the fiat monetary systems. Gold is at all-time highs today, in certainly in US dollar terms, and I believe in basically every other currency around the world as well. Silver appears to be catching up, having broken out past $32 as we speak. And yet the gold bugs index, the ticker HUI, seems to be lagging. Let's start there. What is causing the discrepancy between the bullion itself and the gold bugs index? And why is that important for people to pay attention to?
Well, before we go into the HUI, I
Sure.
wanted to mention something about hedging. Gold as an investment for hedging, and gold as an investment for store of value. Historically, that's kind of what it's been. Insurance. You don't necessarily buy gold to make money, or investors, even miners, to make money, because like in the 1990s, gold did nothing, and then 2010 to 2020, gold did nothing. I mean, so it goes in cycles, and so overall it's a store of value. But if you can catch these cycles, you can make gobs of money. And so it's all about timing these cycles. And I always think of this as kind of a once in a lifetime bet. It's like, I think that gold's gonna basically just rip here. And so now we can talk a little bit about the HUI lagging. So the HUI, the cycle high back in 2020 was 365, and we're under 340 today. So we're not even back to a cycle high, but yet the gold is well above where it was in 2020. It's like, kind of what's going on here.
Mm.
And I've been, I'm on Twitter, and I've been tweeting quite a bit, and basically saying that the miners and silver actually had a cycle high back in May, 3268, and it hasn't exceeded that. So gold has had 15 all-time highs over the summer, and silvers can't even get back to a cycle high, let alone an all-time high. The all-time high is $49. We're not even close to that. And so silver and the miners, they're both telling us a story here. Everybody seems to doesn't see it. They basically think that everything's breaking out. Well, one thing that I've learned is you got to pay attention to resistance levels. Important resistance levels can take months or years to get above. And until you get above those resistance levels, you have to basically be somewhat, you can't get super excited about, breakouts. So the miners aren't running, and if the miners aren't running, there's a reason why they're not running. And for me, the reason why is because gold and silver make such a huge influence on the valuation of miners, that investors are like, I'm not buying those things because they're nervous about gold and silver going down. They want to catch a falling knife. So the overall market is basically saying there's a crash coming. And that's what silver and the miners are saying. But gold is leading here. Gold is following the S&P. Gold in the S&P have been trading 1-to-1 all year. I mean, if you put them side by side, they both basically been ripping higher together, which is unusual. They usually don't do that. They're usually natural enemies. They usually, if the stock market is going up, that means the economy is strong. The economy is strong. People, I don't need no stinking gold. The 1990s are a good example of that. Gold's in the toilet and the market's ripping. That's the natural harmony of things. And so what in the world is gold doing at an all-time high? So gold is, it's sniffing out the debt problem that the US has. The debt, so debt has exploded from 1 trillion to 35 trillion, and we're adding 2 trillion a year. I mean, it's out of control, and gold is sniffing that out, saying, wait a minute here. The US economy, which is 25% of global GDP, cannot live on debt anymore. It has a problem. It's going to have to do something. Something's going to break, basically. And gold is sniffing out these problems that are coming, and Wall Street's in total denial of debt being a problem. And and so that's the reason why the HUI is holding back, because the HUI is like, wait a minute here. I'm not gonna just buy all these miners because gold's high, because gold's going to correct here, because the market's going to correct, and they're going to correct at the same time. And so, and I've been saying this, gold is not going to, I don't think gold is going to, and the stock market are going to go up to $3,000 gold, for instance, and the stock market go to 7,000. I mean, that's a possibility, but I don't see that outcome. What I see happening here is basically hitting a ceiling, and then the stock market rolling over. And once the stock market rolls over, say below 5,200, so today it's over 5,700. Once it rolls over below 5,200, and this is all technicals, it goes below 5,200. Everything's fine and rosy on Wall Street above 5,200, basically. But if you get below 5,200, then everybody starts to notice all these problems. Everybody's ignoring the problems on Wall Street. They're just focusing on GDP, employment, income, inflation going down, stock market up, but they're ignoring all the bad stuff, such as housing. Basically, in August was basically down for new homes and for existing home sales. Retail has basically been in the dumper all year, flat for the year. Inflation adjusted. So you have these problems that are occurring. Everybody's ignoring them. All that stuff's going to start. You get below 5,200, everybody starts seeing them, and that's when. So basically from 5,200 to 5,000, that's when people get nervous. So, and that's when the early sellers sell. Then below 5,000, that's when people start jumping off the boat. 5,000 to 4,800 is when people begin to leave. You go below 4,500 and it's game over. That's when the recession begins. And everybody knows it. And so you get below 5,200 and things really start to shake, if you will. And so my point is this, is that that's coming. I think that's coming in Q4. And if I'm right, that means gold and silver are going to get smashed in the mouth. So you got to be cognizant of that. So people are putting all their money in here thinking, because all the technical guys are saying that gold's going to the moon here, silver's going to the moon. I'm saying, October and November, you need to be aware that there's a very good chance stock market gets smashed in the face and gold and silver go down with it. But the good news is the floor of gold and silver keep pushed higher. Now, the floor in gold, I think, is pretty much 2,200 or 2,300. I do not think we go below 2,200. I don't think we're even going to touch it. My target is 2,250 to 2,350, somewhere in there. That's not a massive drop, but some people think 2,400 is going to hold. I don't. Silver, I think the floor is 25, 26, 27, somewhere in there. Some people think it's 30. I don't think 30 is going to hold. I'll be surprised if 27 holds, but these floors are significantly above where they were a year ago, significantly above. And so since the floors have been pushed higher, that's the bull market showing its face. So the bull market is coming. The bull market is already here in gold, but it hasn't occurred yet for silver and the miners, but it's coming. And I think we'll see it by the end of the year. So even though they're lagging for a reason, but they are getting ready to take off. But before they take off, I think we got one more correction coming.
Okay. And so would that correction most likely be due to a sell-off in the broader stock market and people selling what they have as opposed to what they really want to sell? What's creating that floor? Is it the technicals? Is it still the interest in central bank buying because central banks around the world have been buying up bullion over the last 12 months in particular? What do you think is going to cause the sell-off and what is going to hold the floor in those targets that you mentioned?
Yeah. So I do think it's going to be a broad sell-off. Everything's everything's going to get sold. The only thing that'll basically go up would be the dollar. And I don't think the dollar is going to go up very much. Maybe 102.03, but I don't know about 104, 105. I thought maybe we get back to 106, but I don't even think we're going to get to 104. So I do think the dollar will go up a little bit. And as far as the floors go, what's been pushing those floors up is what we talked about earlier about all this uncertainty in the economy. Can the Fed land this plane and get a soft landing? Can inflation remain under control? There's all these unknowns. And then the biggest one of all is the US bond market. And I really feel that the US bond market is the reason why gold's at $2,700, is that bond market is starting to crack, because it's getting to the point now where we're borrowing 100 to 200 billion dollars every single month. We didn't used to borrow this much money, but simultaneous to that, not only do we need to borrow 100 to 200 billion dollars a month, but our biggest buyers are no longer interested. China and Japan are our biggest buyers, and they're no longer interested in buying. So who's gonna when your two biggest buyers basically are on strike, who's gonna buy this stuff? And so
Right at the
I
time where
think
a lot of the shorter term maturities that were issued, I think about 37% of that debt is due to roll over the next 12 months. And that was issued at sort of in the twos, 2.25. And now you got to refinance or roll that debt over at basically
I,
double the interest cost. That really hurts the fiscal situation. And I think the gold market's sniffing that out and saying, well, to support such a fiscal deficit that's not going to correct itself anytime soon, you're going to have easy monetary policies in a nutshell.
yeah, there's a lot of uncertainty, a lot. And when the stock, I heard this comment from Luke Gromen, and it really stunned me. He said that the stock market, I never thought about it this way, but he said that the rising stock market is actually part of consumer spending. I forget exactly how he said it. He basically said, or basically income, consumer spending, income, GDP. Maybe he meant GDP. But he said that the stock market had to remain high. Um, I've never heard anybody really say this before, but he basically was saying that the overall stock market is a really important kind of pillar of the economy. It's like holding everything up, if you will. Um, and he basically said he actually had a mathematical number on it. How he basically said that I forget the exact words for it, but I think it was capital gains. But it's basically part of the whole system. In other words, if the stock market goes down, it basically impacts the economy. Where I thought it the other way around, that the economy impacted the stock market. And he's basically putting a circular thing, saying that no, it's the stock market's impacting the economy. I'm like, what? Wait a minute, my head can't figure all this out. It's like, isn't it's like, and
Used
so,
to be the other
but
way around.
yeah,
Things have
but his
financialized
point,
themselves a little.
yeah, his point was that if the stock market starts coming down, it's going to create havoc. And I think the stock market is going to come down, and I think that is one of the reasons why gold is up. Is gold is basically smelling out all of these problem areas, right? There's all of you got the debt problem, you got the economy problem, you got all this leverage. And then on top of that, you have the US dollar, where you have this de-dollarization occurring from the BRICS, which is kind of a big unknown. Are they going to start dumping our bonds because they don't need our dollars anymore for their transactions between each other? I actually read today that China, when they're doing the stimulus, but they said that part of the stimulus was to sell their dollars and use their dollars to do the stimulus. Now, I don't know if that's true or not, but that kind of plays into this idea of governments basically going away from the dollar as a reserve and dumping their dollar reserves because they don't need them anymore because they're using their own currency to buy and sell with each other. But to kind of finish this answer, the bottom line is that the floor for gold and silver is being held up by all this uncertainty. And unless this uncertainty goes away, which I don't think it will, I think it's actually going to get worse. Gold and silver aren't going down.
Okay. So you mentioned that we're into a bull market for the precious metals. Let's talk about the ROI side of things. What kinds of return on investments are possible when you have some of these historic bull runs? And then we'll talk about how best to position oneself to profit and to gain the maximum return on investment in such a scenario.
Yeah, so this is what I've been doing since the very beginning of my investing. And I'm one of the few analysts that does this. I really don't know of another, but I'm sure they're out there, is that I focus on future gold prices and future production. I don't care about today. When I invest in a company, I don't plan to sell it, for 2, 3, 4 years. So my idea is, can I identify what the stock price is today, the market cap is today, and then what it's going to be 2, 3, 4 years down the road? And that's how I do things. And that's how I created my website. And so my website actually has a future valuation section, and it shows you what my website says this company is going to, the upside potential of this stock based on, so I have default. So my default is $100 silver, which is kind of a high number, but it's a round number. If I had to do it again, I probably would use 75, but I used 100 as a round number. And my goal number is 3,000, which is it's starting to get too low. I need to bump it up to 3,500 here pretty soon.
Okay.
And so those numbers are my defaults, but you can change them and it'll show you. And then I have future production and then future cost. So if you take those three numbers, the future break-even cost per ounce produced, and then your production, you can calculate out what your free cash flow is going to be, and then you can estimate a multiple.
Okay.
And I'll use a multiple anywhere from 2 to 20. I usually don't go above 20. 20 is really high, depending on the company.
Sure.
And I'll just throw that number in there, and then it'll show me the upside. Well, believe it or not, all of the silver, I think just about all the silver producers today all print as 5 baggers or 10 baggers at $100 silver. They're all super cheap still, but that's at hundreds. But if you back off and you go to say $75 silver, which I think is not that big of a stretch at all, most of these stocks are 3 to 10 baggers, which is amazing. Considering, I mean, if the average person, if he can get a 300% return on an investment, that's pretty darn good.
Indeed it is. Let's unpack that a little more. So over what kind of time frames are you estimating that? And how are you factoring in inflation into the expense column or the cost of extraction really for these metals? Because that's going to make a difference in terms of the margins.
Yeah. So you had 2 questions in there. So the first one is, well, I'll start with the inflationary thing. So I pad the cost. So I adjust for the inflation. So I look at their current cost today, and I basically, and then the timing. So I basically like to go 3 to 5 years out, and then as far as the cost. So if I go say 3 to 5 years out, so and then as far as I'm concerned, I actually think it could happen within 2 years. These very high gold and silver prices. In other words, I actually think that gold, so gold's at $2,700 today. I actually think that gold next year will get above 3,000. I don't think that's a stretch at all.
No, I agree.
So if we're above 3,000 in 2025, there's no reason why, if things don't improve economically and certainty goes up, there's no reason why gold cannot get to 3,500 in 2026. So it's not that far from now. Then if you put a 30 multiple on 3,500, I think you get $75 gold, silver. So you put a 30, I think it's $100. Yeah. I'm getting my math wrong in my head.
Oh, if
But
you're underwriting $100 silver.
yeah. Yeah. So basically as the GSR squeezes gold silver ratios, you get gold to 3,500, silver is going to be extremely higher than it is today. Let's just put it that way. So these returns for the silver miners and the gold miners over the next 2 years should be massive, depending on how high gold and silver go. But just the run, if we just talk about this year alone, there's a possibility that silver could actually run to $50 by the end of the year.
Okay.
If all you do is use $50 silver just for this year alone, and we're only talking about a quarter, all of the silver miners are basically highly undervalued because the price of silver is low and the margins have been low. The margins really don't get, let me put it this way. In order for a silver miner to be strong, if you will, you need the margin to be at least 30%. The average silver miner today has an ASIC of around $22. And so the break-even cost is about 26, 27, which is what we're at right now. So the industry right now is breaking even, but we're now at 32. But it wasn't that long ago, we were at 27, $28 silver, and the whole industry was just breaking even. So now they're making about $5, at $32 silver, the industry's making about $5 an ounce. I have to do the math on it, but it's not 30% yet. So we need to get to $35 silver before the silver industry actually even gets healthy. So since it's not healthy, these miners are all cheap. That's why I said they're all 5 and 10 baggers. It's easy to find undervalued silver miners today.
So would you look at it, given the current state of affairs, you'd look at the silver miners as they're muscle miners breaking even with a big call option, at the money call option, really, as to where we are right now.
Yeah, and so what I was leading up to is this $30 to $50 move in silver this year is a possibility. If that happened, the average stock in the silver miners, there's only about 15 producers out there. I think there's 22, but about 7 of them, they're kind of marginal producers, if you will, small producers or mainly base metal producers. But companies that you actually consider to be silver miners, there's only about 15 of them. Those 15 will average about a 200% return just from silver going from 30 to 50. And some of them will go up 300%. That's a huge move. And believe it or not, that is just getting to the starting line, in my opinion. Because once you get to $50 silver, the margins are going to be so huge. Because if you go to get $50 silver this soon, and I don't think we will, I think we're only going to get to 40. I'm just using 50 as an example. It's a possibility. If we did get to 50, the margins would be so huge that their multiples would start expanding. Everybody talks about multiple expansion, right? You go from like a 15 PE to a 25 PE. I use free cash flow multiples. And I actually think that the multiples today on most of your miners is under 10. And I think just about every miner out there today, you're buying at half off. Just about all of them, they're basically half off. And so we got to get back to normal, which is a 100% return, just to get back to normal. So that all that has to do, that's just multiple expansion. Just back to normal is a 100% move. And some companies, it's actually more than that to get back to normal. And that's just getting back to norm. Then we're going to have multiple expansion on top of that. So what's going to happen is it's kind of crazy, but this is the possibility of these miners, because they're so based on the metal price, is that you're going to have companies that go up a 200% just on multiple expansion alone. And then from there, they're going to grow based on their free cash flow. They're basically, their margins or their multiples are going to stay the same, but they're going to have more income as silver prices go up. So once you get to 50, You get to 50 and all these companies are going to normalize back. So that's when you get the 100, 200% multiple expansion. Then from there, every dollar that silver goes up, they're going to go up in value. And so things are going to get really wonky. Well, you're going to start seeing companies go up. It's going to be kind of bizarre, the kind of the returns that we're going to see if the price of silver keeps going 50, 55, 60, 65, 70. The returns will be phenomenal if that happens. And that's my bet. That's what I've always believed. Now, people are saying, now, Don, how in the hell is silver going to go 50, 60, 70? How does that happen? Only two reasons why that'll happen. Number one is the US bond market. So the US bond market is dependent on buyers. It's dependent on the US Treasury being able to borrow what they need. And if they borrow what they need, if we go into recession, they're not going to want to cut spending. So the deficit's going to be above 2 trillion next year. And so the bond market, they're basically going to, as long as the bond market stays healthy, then I'm wrong. But if I'm right, what's going to happen is the bond market is going to start to crack. It's not going to break. It's going to start to crack. And when it starts to crack, the US bond, especially the 3-month, has always been considered zero risk. Zero. That's what it's always been historically. My point is that once that is no longer true, once people start to think in terms of even my 3-month bonds aren't risk-free, then everything starts to get repriced in. Well, guess what else gets repriced in? Gold and silver. And so there's that. And that's that if you don't really, if you believe that the US economy is either healthy today or it's going to return to its health, then stay away from gold and silver miners. But if you're like me and you believe that the US economy is actually in big trouble, then these miners make a ton of sense. There's that. Now, the other thing, so if that happens in the US, people put their money in banks and in stocks and bonds and in real estate. And everybody is comfortable in those investments. So the first place of confidence to go down will be stocks. And the second one will be bonds. And the third one will be banks. And once people become nervous about all three of those, especially banks, like, a lot of people have a lot of money and their savings in banks. Can be a considerable portion of their net wealth. Well, if they're not comfortable with that money in the banks, they have to make a choice or a decision on how they move their money around. And the one place that people are going to move it to is gold. And so when they basically, let's say that somebody has like $250,000 in cash in a bank, and they start to get nervous that, you know what, I'm starting to see some of these regional banks fail. I'm no longer really comfortable with my 250 grand in the bank. Maybe they do a bail-in, maybe they devalue the currency. I'm just not feeling super comfortable now with all that cash in the bank. I used to be very comfortable. So they're like, maybe I'll take 10% of my cash and put it into gold, or 20% of my cash and put it into gold. Well, the average person, I'm leading up to a point, the average person cannot afford to buy gold. It's $2,500 for a coin. People can, and they don't want to pay the high premiums for a half-ounce coin, so they can't afford to buy gold. But they have $500 to $1,000 a month they can put into silver. And so silver is the proxy for gold. So this is what's going to happen. And their inventory levels are very low on silver. So what's going to happen is that silver, there's really like only 4 ways to buy silver. The first one is coins or rounds. And the next one is the 3 bars. So you have coins or rounds, which are basically 1 ounce. Then you have 5-ounce bars, 10-ounce bars, and 100-ounce bars. Well, most people don't like those 100-ounce bars because they're very expensive, and so that they prefer is 5-ounce and 10-ounce bars. And so what's going to happen is once those, first of all, your local coin shop won't have any 5-ounce and 10-ounce bars. You can forget about that. They'll be gone in a heartbeat. Once silver's above $35, it's basically a giffen good. The higher the price of silver goes, the more they're wanted. So once you get to $35 silver, the 5 ounce and 10 ounce bars in your local coin shop, forget about it. You won't be able to find them. So then you got to go online. So the biggest website in the US is APMEX, American Precious Metals Exchange. Once they're out of 5 and 10 ounce bars, I can guarantee you all the other ones will be out within a month. And that won't happen long. And so it'll be just wiped. The 5 and 10 ounce bars will be gone. And then there'll be some hundreds, and then the hundreds will finally be gone. And then all of those companies, in order to restock, they're going to have to buy 1,000-ounce bars. All the refiners will have to buy 1,000-ounce bars to create the inventory again. And so once this all begins, now we have social media, it's going to all be word of mouth. It's like, there's no silver. I can't find any 5 and 10 ounce bars. And then that's when the billionaires come in. Then the billionaires come in and go, silver's going up. I think silver's going to go to 100. I'm going to buy some 1,000-ounce bars. And so then they start buying 1,000-ounce bars. And there's just not enough inventory. And so I think what's going to happen is you're going to get a shortage. And that's what's going to drive $50, $60, $70, $80 silver, are these shortages, is that you can't find any silver. I just think that there's not enough silver for retail and fabrication. The combination of solar panels and EV cars, those two guys right there and retail. It's a three-pronged. So you got demand for solar, demand for EVs, and then demand from retail. Those three players are going to suck up all the inventory.
Interesting. So that's a likely scenario to cause the price of the metal to rise. How then are we playing it? Are we playing bullion? What do you think? Let's go in order. Let's talk the major cap, or the mega caps first, the larger producers, your Pan American Silvers, your Newmont, your Agnicos over in the gold space. Silver doesn't have very many pure plays on it. So perhaps we'll talk about larger caps, and that it's basically Barrick, Newmont, Agnico, maybe Pan American. How do you see the relative value between the large caps, the mid caps, the small caps, and then off to the one side, we'll place the royalty cos? How do you see the current setup for those particular levels of the market?
Yeah, so I think the majors is a place a lot of people are gonna go to, because they're fine with 100% return. People think in terms of annual returns. So like, oh, I'm going to get a 50%, 100% return from Newmont or Barrick, plus I'm going to get a dividend, or Agnico Eagles, and it's less risk, so they're going to play those. So the conservative investor is going to play the majors, and the majors, I think, are going to be between now and $3,500 silver, are probably going to be three baggers. Some of them might be four, but I would expect
pretty good when you get paid a dividend to wait.
Yeah, if you're going to get a 200 to 300% return with a dividend, a lot of people are going to be playing these majors. But I think it's a mistake.
Okay.
Because I think this is a once in a lifetime opportunity. And so for me, some of the lower end majors, I think, are kind of easy four baggers, if you will. So that's kind of the Kinross's and the Evolution Minings. I think those plays, the big, they're almost big mid tiers. They're right around 5 billion, say 3 billion to 10 billion. There's some in there that I think still El Dorado. I think some of those are still in the four bagger camp. But me personally, I would stay away unless I was after income. I'd stay away from the Newmont, Barrick, Agnico Eagle, and Goldfields and North Star. The very biggest, I would avoid those and focus more on the ones that are one tier below that, and then I would load up on the mid tiers. I think the mid tiers is where you're going to get an average of 5x on your money, which is huge. And so if you get 5x on your money, then I think that is the best place to be. So I've been buying as many mid tiers as I can get my hands on, if you will. And I love to buy cheap mid tiers, but anything that, 5x or above, and then I will go 3x, 4x if I think it's kind of a growth story. some people will ignore those pricey stocks, but I think they're missing the long-term growth upside on some of them, like I-80, Orla, G Mining. I mean, these are kind of pricey mid tiers that most people don't touch, but that's in that upper tier that I think are growth stories that will be a little aggressive. SSR Mining, if they can get their problem fixed, I think they're another one of those ones that kind of fits in there. And then mid tiers anywhere from 150 million up to 3 billion. But yeah, I think that's where you want to overweight yourself. And then in the juniors, I don't like to do too many small producers. I'm very picky on that because I just don't think they generate enough free cash flow to grow the company, and the risk reward just isn't there. I'll do a few small producers, but not that many. I think I did Luca Mining. I think that's a small one, and Impact Silver. But I'm very low allocations on the small producers. And then the juniors, we'll break the juniors into developers and exploration. So developers, I love developers, but you got to be very picky on those as well. I have like these check boxes. I like 6 check boxes that I want to make sure that a company checks all the boxes is what I say, and then has a path to production. But I have like 25% in developers because I think they can turn into producers. They tend to break my heart because so many things can go wrong on a development story, especially share dilution
Mhm.
or takeovers. But I think developers play a, I think they work as a risk reward as far as when they work, they really work. I mean, these are your 10 baggers. Your producers are more your 5 baggers. And then go down and export. And then the last bucket, oh, we have 2 more buckets. We have royalty. And then in exploration, I prefer optionality. I found that early drill stories, the risk reward just isn't there. Some of them work, but most of them don't. But if you can get optionality, if you can buy gold in the ground for less than $10 an ounce, I think it works. So, Free Gold Ventures, Banyan, um, these are companies that have lots of gold. Like Free Gold's got like 20 million ounces. Banyan's got like 8. And then you got Southern Silver, which is a silver miner, has like 350 million ounces at 50 cents. Collective Mining, they think they have 15 million ounces. So I like to buy these companies that have a lot of gold and silver in the ground with their exploration plays. They can add to them. Tudor Gold is another one that has 20 million ounces. So if I can buy 20 million ounce project and I can buy it for less than $10 an ounce in the ground, I think the risk reward works on those. And then we'll go to royalty. So royalty, I think royalty stocks they kind of fit in that top bucket of the majors. These are companies that have very good risk reward, low risk, and they basically going to give you a 3-bagger, and you're going to get a dividend. So if you like Newmont, you should love Weaton.
Mhm.
That's the way I look at it. It's like I think the big royalties, the Franco-Nevadas, Sandstorm, and Weaton. I think those are all they're very similar to the majors. You're going to get your 3-bagger with a dividend. And then some of the other ones, the Triple Flags and the gold royalties, those can be 5-baggers. Those are a little more risk you're taking on, but more upside.
Indeed. Yeah.
And there's one actually I think it's Australian based Vox Royalty. I like that one. I don't own any royalty companies because like I said, I'm not in the Newmont. I'm not in that. I don't chase the 3-baggers other than I do mutual funds, which are basically have all those in there. I use mutual funds instead of majors, instead of royalty. I use the mutual funds for income.
And
Um,
which funds like your SILJ ETF? Was it the
no,
Corrective?
those are ETFs. I do own 6 ETFs as well, but I don't do the ETFs for the majors. I don't do GDX.
Sure.
I do GDXJ, SIL, SILJ. Sprott has a really good one, SGD. I forget the
Yep.
DJ. I forget. They have a
Yeah.
gold junior ETF that's fabulous. It's one of the better ones. I like it better than GDX. And there's one GOAU that I have that I like. It's another one. But I do the ETFs more. I don't do the, the GX. I do the mutual funds that I do. Those cost more on an annual basis. A lot of people don't like to do mutual funds because it costs like 5% to get into them. And then you have to pay like 2% annual fees. So people won't touch it with a 10-foot pole. But what I really like about the mutual funds is they actually pay out on an annual basis your capital gains. So it's a true income stock. So if a gold has a really good year, you get a big check at the end of the year.
Okay.
And I really like that. So it's a really good way for income. If you want to, get a chunk of money, then you can use that money to invest in more companies, if you will.
Okay.
So that's how I started it, by the way. I started in gold mutual funds. 1990, 91, I bought a gold mutual fund. I still own it today.
That's the year I
And
was born.
my cost base, that's interesting. My cost basis is zero on it.
Okay.
And it's today it's worth over $120,000 right now.
Yeah.
And my cost basis is zero because of the dividends that I've gotten back. So
Uh,
and then 120,000 bucks. If gold has a big year, I'm going to get a check because they pay out the capital gains. I'm going to get a check from them for like $35,000 this year is possible. If
significant.
gold gets to, I don't know, if HUI gets to 380, 400, somewhere in there, I'm going to get a big check from them. So that's
And
what the
then
mutual fund does.
are you taxed on the individual level, or the mutual fund takes care of the taxes
Yeah,
on the
yeah.
capital gains and then distributes it?
Yeah. You get taxed. They pay it out. That's the thing I like about the mutual funds is they pay out all of your annual dividends and capital gains annually. So you got to pay taxes annually.
Yeah.
So you don't get there's no long-term capital gains on mutual funds. But like I said, if gold has a big year, they send you a big check. So it's just for income. But most people don't touch it because they can't they won't pay that 5% entry fee. I'm
Yeah.
not paying 5%, screw, and then I got to pay 2% annually. No way, I'm not doing it. So
It's very
nobody will touch it.
short-sighted, whereas the
But
dividends, as you've mentioned,
but
have more than
all you need is a couple of good years, and it really pays for itself.
Okay. So let me circle back into a couple of questions I had. You said if you like the majors, if you like Newmont, then you're going to love Weaton. What's the advantage of me buying the Newmont as opposed to just buying Weaton in that case?
Um, as far as I'm concerned, they're very, very similar stocks as far as risk reward goes.
Mhm.
Especially in the near term. I think Weaton will outperform Newmont. But I think Newmont might have a better dividend. It's hard to say.
Okay.
The royalty plays have never really had really high dividends. They tend to put their money back in. So it's a really difficult comparison because they're very similar. They're going to have in my opinion, they're going to have very similar returns.
The
If you
payout
own
profile will be
Weaton,
different.
it's hard to predict which one's going to do better. However, this is where it gets interesting. All right. I generally don't like to talk about this too much on podcasts because people have strong opinions. But my feeling is that once we get above $50 silver, for the Nick until silver gets above $50, the royalty model's fine. But I think it's going to be silver that basically pops the model, if you will.
Okay.
But once you get above 50, and I don't know where it's going to be, it could be 60, 70, 80, somewhere in there. At a certain point, somebody's basically going to say, no, I'm not paying you. Because because the contract's going to be too one-sided, because the way these contracts are written, they're written for the life of the mine at a fixed price. So a lot of these silver contracts are at $4 fixed. In other words, Weaton, they only have to pay $4 per ounce. That's it for the life of the mine fixed. So at a certain point, they're dependent on that income to show their shareholders from quarter to quarter. And if somebody doesn't pay them, is going to have a news release saying we have a legal dispute. Well, they have a legal dispute, their share price is going to go down. Well, yeah, they're going to win the legal case. They're going to win in the court of law because it's a contract.
Correct.
But how long is it going to take to get resolved? That other company's like, I'm not paying you. We're going to go into the courtroom and I'm going to argue that the contract's one-sided. Now I might lose, but what if that judge sides with me? What if I can get a jury trial? Does the other company, or does Weaton really want to do a jury trial to figure out if this is a legitimate contract or not? I mean, don't we
I
live
see
in don't we
exactly
live
what
in
you're
a
saying.
don't,
I'm
don't
a
we live in a
shareholder of
world?
Masabi Trust, and this exact thing played out. Masabi won the case, and so their price has gone up nearly 100% since I bought it. But it's exactly as you're illustrating here. That's how it played out.
And it's going to happen. It can happen over and over again. But the thing is that once somebody wins, it's like that. It's like the cigarette thing, right? Once you lose one case, you're dead, right? All it takes is one case, and it changes the whole model. And so I just feel that the model starts now. The way the model is set today, if you're a strong royalty company like Franco-Nevada or Weaton, you get valued at 30 times your revenue. It's like you get these huge margins, you get these huge multiples. And so that's what's going to shrink. So right now you're at 30. If the model starts to break, it'll start to shrink. So it'll go 28, 27, 25. How much lower is it going to go? And so once that starts, once the valuations start to drop, then people will sell their stock and you'll basically be holding on to a stock that's not doing as well as you thought. So my point is this, is that Weaton versus Newmont is kind of a full coin flip for the next 2 years. Who's going to do better? But once silver gets to like 60, $70, I'd rather hold Newmont.
That's a very good point. It's a very good point to be considered. I'm looking at the market cap allocation of the SILJ just for illustrative purposes. And according to what I'm looking at, nearly 7% is in large cap, 32% allocated to mid cap, and then 61% allocated to small cap or less than 2 billion as defined by here. How does that compare to your own allocation when you're looking at the producers? Would you say that's roughly right? And if so, is it worth doing the extra work to kind of pick the alpha of this sector? Or could a generalist just buy the ETF and do well enough based on that allocation?
It's interesting that you ask. I actually just did this exercise yesterday. Let me see, how can I find it? I don't want to spend too much of the time looking for it.
It's okay.
I can't search by my name. One second. I did my allocations yesterday, and so I know exactly what they are. So I'm pretty sure.
No problem. We can smooth it over later. And 60% is allocated to Canada, 16 to the US. So Canada certainly has the lion's share of allocation in terms of geographic weighting.
Okay, give me 1 minute here to see if I can find this. Okay, you asked a question on my allocation. So I actually did this exercise yesterday. So I have physical silver at 7%, crypto at 6.3, ETFs, mutual funds at 16%. And each one I have 9 total, and they're allocated anywhere from 2% to 5% each. And then producers, I have 33%, and I allocate 0.5 to 1% with a few over 1%. Then developers, I have 29%, which is a little aggressive, and those are 0.25 to 0.5 with a few over 0.5. And then explorers, I have 7%, and those are 0.25 or less, with a few over 0.25. And then cash, I have 2%. So
Okay.
total.
Interesting. Well, you certainly are looking for the big multi-baggers there with the developer allocation. I like it. So we're coming up on the hour. Where can people learn more about you and goldstockdata.com? And what are they going to learn by joining you at goldstockdata.com?
Yeah, so first of all, for my website, it's not for newbies, it's for people that already own gold and silver stocks that need data. So it's not a stock picking service, although people use it as a stock picking service because I create a website, I create a newsletter and I give them a bunch of lists. But the lists aren't meant to be go buy these, even though I do rate them. The purpose of the website was always to provide data so people could do their own research and get leads. I'm basically saying, these are stocks I like, go look at them, see if you like them too. And I've written a book, um, which is basically a textbook on how to invest in gold and silver mining stock, which is on Amazon. You can put a link below on yours.
Certainly.
Um, and so if you are a newbie, if you don't own any gold and silver mining stocks, then read the book. And then if it interests you, then come and join Gold Stock Data. But it's a fantastic resource for anybody that does own a gold silver mine stock and wants to buy another one. It's fabulous for that. The database has 800. It has basically all the gold and silver mining companies in the world, 850 of them, and so it's a great resource for that. And then you want to follow me on Twitter at Don Durrett. I have my own group, and they basically allow you to create your own group and it's gold and silver mining stocks and Twitter, and you can ask to join. So there's no bots in there, which is nice. And it's
That's
only the only topics we talk about is gold and silver, so which is nice. And then if you can follow me on Substack for free. If you do that, you're going to get my Friday night and mid cap recaps every week. You get that email to you. If you go to
great.
Substack, search for Don Durrett.
Okay, excellent. We'll have all those links in the description. Thank you very much for joining me, guys. Take care, and I look forward to catching you in another episode of the ROI podcast. Take care, guys. Bye now.